Borrow Smart segment. Want to chat? Borrow Smart segment brought to you by rsrdebtfree.com. rsrdebtfree.com. I'm trying to find my notes on this one because I've had it in our on our agenda, on our rundown for quite some time. And what happens frequently is I get talking too much, so I don't find the report or I don't get to the report. Today we're going to do it. What exactly is mortgage APR is what our subject will be. Borrow Smart again, brought to you by rsrdebtfree.com. Many are all, let's see, mortgage APR refers to the total amount of interest you'll pay on your mortgage yearly. Learning how to calculate APR can save you a lot of money over time. What is mortgage APR? Is a common personal finance question with a fairly straightforward answer. Mortgage interest rate and mortgage APR are two closely related yet distinct concepts that you'll encounter when discussing mortgages. The interest rate is the amount you're responsible for paying on your home loan each month. The APR is the interest rate plus other fees and costs associated with buying a home or with getting the loan. When looking for a good deal on a home, it's important to know how mortgage rates can impact your expenses. We're going to help you better understand what goes into mortgage APR and harness the knowledge to find the best loan for you. Key takeaways. Mortgage interest refers to the amount you're charged each month. Mortgage APR includes your interest rate and other fees that you're responsible for paying. APR includes interest, broker's fees, origination fees, discount points, interim interest, and more. What is interim interest? Because that's the number that allows mortgage people to manipulate the APR during the process. What do I mean by manipulate the APR? Well, being you're talking about, you have to understand what is interim interest. So when you're getting a mortgage, you always pay in arrears. When you rent a property, you pay in advance. What is arrears? It means you're paying for something that already happened. So when you pay your April mortgage, you're paying the interest for March. When you pay your March mortgage, you're paying the interest for February. Well, most people don't close right on the first of the month or the last day of the month. So there's some time period before you get to that before you get to that interest period. So let's say you close your loan on the 15th of April. Well, your first payment is not going to be until June 1st. Yes, I know that you get in most cases, you're going to get a 15-day grace period till the 15th, but let's just talk about the initial numbers and go with the 15th of April. Well, you're going to pay interest on that money because you've borrowed it from the 15th through the 30th. So that's what the interim interest is the 15th. Now, why do you say, Ron, how do you say it's manipulated? Well, the reason I say it's manipulated is because if one lender understands this and they just say you go in your loan's going to close on the 5th of April. Well, you're looking at 25 days worth of interim interest, and that goes into the APR. Now, let's just say that a different lender says when they do your documentation, they put out that you're going to close on March 31st. Well, then you've got zero interim interest in the APR, but it's going to show up later on at the end after you've already got to the 11th hour. It's going to show up at the very end, and that's how it's manipulated, is through that process. So you just want to be real careful when you're looking at these things. So that's the manipulation part, just so you understand. APR is what you'll pay on top of the principal of your loan, the amount you borrowed when you first took out your home loan. This is why APR is sometimes called the percentage rate and is one example of many confusing mortgage terms deciphered by us in a regular basis. If you have a higher APR, then you expect to make a higher monthly payment for the term of the loan. You also want to really compare APRs and not just the flat interest rate. This is an article. So I got this article, and this came to us from credit.com. Credit.com. And the reason I bring that up is because sometimes you get good information from some of these places, sometimes you don't. So here's one where they put in here that the APR is what you pay. No. When you put in your mortgage calculator, you put in the interest rate. You do not put in the APR because you're not paying that every month. You're paying the interim interest. You're paying the broker fees and closing costs and discount points. Those are all paid in a lump sum. Now, you can amortize them over a period of time, and that's what the APR does, but it's not in your monthly, it's not part of your monthly payment. If you put in the APR to get your monthly payment, you're going to get the wrong number in your calculation. So I hate it when some of these places they go out there and they give you this information, but don't really keep it clear, because I can show you that when you do an adjustable rate loan, sometimes your APR is way below what the interest rate actually is going to be to get going on it. So I just want to make sure you understand that APRs can be manipulated. So I shared with you how that is. What is a good APR for your mortgage loan? It's going to depend on the person, but a lower APR is almost always better. But why do I say almost? Well, I'm going to share with you something I tell a lot of organizations, and a lot of people listen. Some people don't. Strategy beats rate always. Strategy beats rate always. So I had a client that had a very, very short-term hold on a property that she was refinancing. The property was owned free and clear. They just needed some money for a very, very short period of time. I think it was like 8 or 10 or 12 months, something like that. Well, we went and used a much higher than market interest rate so that we can get them a lender credit to pay all the closing costs. So whenever you hear that somebody's paying all your closing costs, be careful. What that means is they're charging you more interest to cover those closing costs. Somebody has to pay them. Buyer always pays. It doesn't matter what, buyer always pays. Just think about that. If you go to McDonald's and want to buy a Diet Coke, do you really believe that they're not charging for the cup? It's built into their cost of sales. So the buyer's paying for it. I digress. So let's go back to this one. The concept here is the buyer's paying for these things. And in that scenario, we charged more. There was no cost for the loan. It gave them enough money to pay back their for the lender, for us to pay all of their fees. So let's just say the fees were $3,000, and I don't remember exactly what they were. And let's say that the higher interest cost them $40 a month. Well, remember I said they're keeping the loan only for a year. So let's see. Would you trade $40 a month times 12, $480 to get $3,000 in savings? Trade $480 to get $3,000. How many times do you want to do that? You say, Ron, I'll do that all day long. I'll go borrow the $480 if you're going to give me $3,000. Of course you would. So strategy beats rate always. So not always is the higher APR the wrong program for you. What's wrong is only considering interest. And it's fascinating how many people I talk to, the only question they want to know is, Ron, what's the rate? Well, the rate can be whatever you want it to be, right? It could be 5% right now. That might not make sense for you to get a 5% rate, but we could do it.